Moody's downgrade? Bitcoin doesn't care. 108k in sight. Bitcoin is skyrocketing again, now pushing above 106k. And in today's video, we are breaking down exactly what's driving this move, and more importantly, what it means for you. Over the weekend, the price action looked shaky. Moody's downgraded the US credit rating, and that triggered a pullback across global markets. Bitcoin held up better than most, but altcoins got hit hard, and the market felt quiet. But now, that's changing. Bitcoin has broken out of its weekend range between 103k and 105k, clearing short positions and surging as markets open into the week. Hi, I'm Neil, and today we are going to look at why this breakout is happening despite global macro stress, while whales didn't sell, and what it says about the strength of this move. We will also break down why retail is still out of the picture, what altcoins and funding rates are telling us, and how global liquidity is quietly shifting. Later in the video, we will dive into the heatmap and CVD to see what whales are doing in real time. So let's jump in. Here's the big headline from last week. Moody's downgraded the US sovereign credit rating by one notch, the last of the three major agencies to do so. With S&P and Fitch already having downgraded the US, this now officially removes the country from AAA status across the board. That's not a small deal, to say the least. Typically, when a country's credit gets downgraded, investors demand higher yields. That pushes interest rates up, borrowing costs up, and stock market sentiment down. And that's exactly what we are seeing. 10-year treasury yields have started to spike again. But while Bloomberg analysts suggested this could lead to profit-taking and the end of the equity rally, Bitcoin just did the opposite. It rallied. So, why is Bitcoin pushing higher while risk assets wobble? Here's the logic. A US credit downgrade weakens trust in government debt. Higher yields increase long-term uncertainty. Bitcoin, as a decentralized asset, benefits from distrust in centralized systems. Treasury Secretary Scott Bessent responded by downplaying the downgrade, saying it was, quote, a lagging indicator. He also pointed to long-term economic strength, Middle Eastern investments, do you remember last videos? Rising foreign capital, and ongoing trade negotiations with China. But the market seems to be sending a different message. Investors are looking for alternatives, and Bitcoin is catching that bid. Interestingly, we are now seeing gold and Bitcoin rise together. That's historically rare. What it signals is simple. Bitcoin is behaving more like a hedge. Investors are rotating out of bonds, but they are not putting it all back into equities. Some of that capital is flowing into Bitcoin and gold. This decoupling is important. As US equities start to diverge, Bitcoin is carving out its own path. One that's driven less by Fed expectations and more by trust, liquidity, and global positioning. On the data front, US consumer sentiment took a big hit. The University of Michigan index dropped to 50.8, the second lowest print since 2022. That's 5 straight months of declines. And it shows that inflation isn't the only concern anymore. Consumers are pulling back. Sentiment is falling, and that's exactly when assets like Bitcoin often outperform. We also got PPI data, with core PPI dropping minus 0.4%, the weakest in 5 years. Retail sales missed as well, down minus 0.2% on the control group. Translation? Inflation is fading, consumption is fading, and the Fed is in a tough spot. So, how does this reflect on-chain? Let's take a quick look. Accumulation trend score is at 1.0, broad-based buying by large entities. Daily return on realized price is climbing but still low, showing we are early in the cycle. SOPR flipped positive post-May 8th, indicating short-term holders are now in profits, and yet leverage remains low. Funding rates are flat. This isn't a leverage-driven pump, it's organic, spot-driven demand. We also see only 2 out of 10 trend reversal indicators still bearish, the Bitcoin Network Activity Index and the IFP. And if those flip bullish, we might be entering the steepest phase of the move. Another major signal, USDC inflows. This week alone, 1.1 billion in USDC has moved onto exchanges. That kind of stablecoin inflow usually precedes serious buying. When it happens during consolidation, it often signals that big players are preparing for the next move. MicroStrategy continues to accumulate. Founder Michael Saylor shared another seller tracker chart this week, and a new purchase announcement is expected within days. ETF inflows have also picked up again, particularly into IBIT. And globally, we are seeing large players like Abu Dhabi's sovereign fund added to Bitcoin exposure, 480 million USD into BlackRock's ETF. Coinbase was added to the S&P 500, rising 8% on the news. And major asset managers like Fidelity and JP Morgan are raising targets for Bitcoin in Q2. So let's break down what this 24 hours liquidation heatmap is showing, because this wasn't just another move. It was a staged breakout, followed by a liquidity sweep and heavy interaction with key resistance levels. Bitcoin began the session around 103.2k, trading in a narrow range between 102.8k and 104k. This period was marked by consolidation just below the 105 key resistance zone. At approximately 10 p.m. UTC, price began rising gradually, a steady climb driven more by spot accumulation than by liquidations. As price entered the 104.4k to 105 key area, yellow and green heatmap bands began to stack, signaling short liquidations and visible sell pressure. This zone marked the first key resistance, and Bitcoin briefly pushed through. The move extended up to 106k, triggering a short liquidation cascade. However, momentum stalled once price reached the 106k to 106.5k range, a thick resistance zone. The breakout failed to hold, and price reversed sharply. Bitcoin declined to 103.3k, triggering long liquidations along the way. The heatmap shows strong bids between 102.8k and 103.4k, a support zone that absorbed the move and provided a short-term bottom. From there, Bitcoin recovered, climbing back to 106k, briefly breaching to 106.5k zone and reaching a session high of 107k. However, the move was rejected once again and price pulled back to around 106k. Key resistance zones: 107.8k to 108k, densely stacked sell orders forming just above recent highs. 108k to 111k, broader resistance zone if the rally continues. Let's see the key support zones now. Minor support near 106k, 105.5k and around 104k to 104.5k. Stronger support between 102.8k and 103.2k. If that zone breaks, downside targets could include 101k. Conclusion: this chart illustrates a typical liquidity compression pattern. We've seen both long and short liquidations cleared, and price is now positioned just under resistance. Both buyers and sellers are active, waiting for a trigger. If bulls can break cleanly through 107k, 108k with volume, the next leg could extend to 110k or higher. But if 103k fails to hold, a correction toward 101k remains possible. The range is tightening, expect a decisive move soon. Now, let's take a look at what the CVD chart tells us, because it gives us a real-time view of who's behind this rally and where things might go next. Mega whales, 1 million, 10 million, the brown line. This group, most likely institutions, has been steadily accumulating. They are not reacting to price, they are building positions. Even through short-term pullbacks, their buying pressure has stayed strong. That kind of behavior usually means one thing: they are preparing for bigger moves ahead. Large whales, 100k to 1 million. Purple line. After staying quiet earlier in the month, this group is back in the game. Their line has spiked sharply over the past 48 hours, showing clear buying into the 104k, 106k breakout zone. They are now closely aligned with the mega whales, reinforcing institutional confidence around these levels. Small retail, $100 to 1k, the green line. Interestingly, we saw some fresh buying from this group midweek. They joined the rally for a bit, but as price hit resistance near 106k, that momentum faded, and their flow has started to turn flat again. Mid-sized whales, 10k to 100k, the red line. This group led the early part of the move, but now their trend is turning. we are starting to see profit taking, which is pretty typical. Mid-sized players tend to jump in early and exit into strength. And that's exactly what the data suggests is happening now. Retail, 1k to 10k, the orange line. Retail in the 1k, 10k range has been trending down for over a week. This group continues to exit, showing hesitation even as price moves higher. The total CVD, you can see the blue line. The overall CVD is climbing, but here's the key. It's been driven mostly by whales. Retail is still on the sidelines. This confirms that the rally is being led by larger players, and that often means there is still room for continuation. So, here's the big takeaway. Despite Moody's downgrade, Bitcoin didn't flinch, it climbed. Institutions are still accumulating. Retail is still mostly on the sidelines. And on-chain data? It's telling us this rally is early, not exhausted. Liquidity is coming back. Macro is shifting from inflation fear to recession risk. And Bitcoin is acting more like digital gold than ever before. But the structure is coiling. We are right below resistance, and the next move could be fast. So, what do you think? Are we about to blast through 108k and head toward 110k or even new all-time highs? Or do you think we get one last dip first? Let me know in the comments, I read every single one. And if you found this breakdown helpful, make sure to like, subscribe, and share it with someone who needs to understand where this market's headed. Thanks for watching, I'm Neil, stay sharp, stay ready, and I will see you in the next one. Bye bye.